Do you agree with David Solomon that we're on the brink of what he's basically saying is normalized activity in the capital markets, and these IPOs, ARM and Instacart, could give a lot of more juice to the markets?
Well, I mean, I think I agree with him that the market has swallowed the rate hikes that we have had so far, which is a blistering pace by historical standards. That many companies have figured out how to operate in this new environment. The markets themselves are still figuring out what pricing makes sense. And so, the choppiness we've seen this past week is probably going to continue this quarter. So I think David's point is really that if we can psychologically get some successful IPOs under our belt, we can start to move past this moment and get on with, what comes next after interest rates stay higher for longer.
Gina, I want to bounce this fund strat note off of you. Speaking of the choppiness in the market, this one basically saying if the S&P breaks 4410, I suspect that a quick, short-lived decline should take place, which likely could test and break August lows. Thereafter, I expect the S&P 500 likely pushes back to new 2023 highs. So you mentioned some of the rate pressure and a few other things. So once we get past this period of choppiness, do you just see a definite uptrend when it comes to the markets?
It depends. It's interesting that the FOMC members are each kind of continuing to hold open the option that we may need another rate hike. This pause isn't the end. And right now, bad news is good news for the markets. Is if we hear that the labor markets are soft, then we get little short-lived rallies. And I think that the markets are ready to move past this. So if we can get through this without the Fed over-tightening, and that's the big question, does the Fed over-tighten and turn a mild slowdown into something worse? Well, that changes the equation, right? Then it's not all uphill from here.
Speaking of news, we got some news on Apple this morning. Chinese state officials putting out a statement saying they welcome all devices, obviously responding to reports that they were considering a crackdown of iPhones in China. Looking at the stats on Apple, Apple's 7% of the S&P, almost 12% of the NASDAQ 100. Right now, Apple's pretty much flat after that report from China. But if we continue to see selling pressure on Apple, does that pretty much ensure we're on pace for another down day for the NASDAQ and probably another down day for the S&P?
Well, I actually think it goes farther than that, Frank. I think that is the kind of concern that would affect significant portions of the S&P. The S&P is a very internationally driven set of companies where sales into China are not an insignificant part of S&P sales. What is happening with Apple is, I think, the tip of the iceberg of something that could be far worse in terms of losing the ability to sell into China.
Really? So is there any other sector that you think is especially impacted by other restrictions, or if this is a bigger trend?
No, I mean, I think I guess the point that I'm making is this is going to be, tech is the sharp end of this conversation, but it's not as though the relationship between the U.S. and China is getting better. If anything, I think that here's what we know about China. When it chooses to reject some portion of the market, it will be called an infringement of some regulation that you didn't, they'll just simply go after certain companies. And we saw that internally, right, within China's internal politics.
Okay.
We saw China going after tech companies inside of China. And so I think tech is the sharp end of that stick, but it could expand potentially to consumer products. It could expand.
Right.
I'm
going down a slippery slope.
to get
even
slope.
bigger. I got you.